Hello and welcome to the digital edition of the ESG Clarity magazine for March. Today I'm joined by Phoebe Stone, Head of Sustainable Investing at LGT Wealth Management. Thanks so much for coming in today.
Absolute pleasure, Natalie.
Excited to find out a bit more about the business. Yes, tell us about LGT Wealth Management. I know that there was a big focus on sustainability, so how is that really embedded in what you do?
So the history of our business goes back to 2008 when we were Vestra Wealth. If we fast forward then to 2016, we were bought by LGT, a very, very large wealth and private bank based out of Europe, but actually has global presence. Now, LGT is owned by a single family based in Europe, and this family has been around in some guise or another for 900 years. They really think in terms of generations. They started building a banking business back in the 1920s. They have an authentic and genuine 20-year business plan. Mm-hmm. So sustainability and thinking about being around in the next 200 years is really, really crucial to the way the company thinks and acts. It enables us to invest for the long term. We don't have quarterly shareholders to respond to, so we can take investments, and that's things that we've done recently in carbon capture and storage space, for example, but also evolving our business from being carbon neutral, which was something that we've had in place since 2010, much earlier than the rest of the industry, to a net zero ambition by 2030. So that comes from the very top. Yes. Our chairman strongly believes in sustainability. Our CEO is on calls with us on a regular basis, thinking about things like biodiversity risk, climate risk, and that filters all the way down through the organisation. So in terms of the investment in my team, in the sustainable investment team, we've decided to build our own resources internally. So that's a tool to analyse ESG risk, analyse impact, building a stewardship platform, and that's a global platform, but we've got a lot of expertise here in the UK. And our clients are increasingly wanting more and more information, which is great. And we really want to be able to do that research, do that analysis and provide that information so that we have an authentic approach to sustainable investing.
Okay, fantastic. And how do you consider sustainability when you're investing for portfolios? What are the factors that go into that?
Sustainability is such a huge term. And I think that it's seen as a bit of an umbrella term to capture negative screening if you're going to exclude certain companies based on revenues or activities, ESG integration, so looking at non-financial data. I think it's fairly well accepted across our industry now that using this non-financial data to understand a business's risks or opportunities should be part and parcel at some level within an investment process, but also thinking about contribution to tackling global challenges. When we're selecting third-party fund managers for the model portfolios that we run for financial advisors, considering the intentionality behind that allocation of capital is a really important part of our process, and I would say sets our process apart from some of our competitors. Now, doing that intentionality assessment is obviously very challenging. It's a mixture of quantitative analysis and getting responses back from DDQs and information gathering, but also meeting the managers, scrutinising their holdings, really picking apart how a fund manager is approaching something like biodiversity risk, for which there isn't a simple answer. Yeah. There isn't a lot of data around this stuff. Exactly. Or how they're thinking about transition risk in a particular country or supply chain management risk. And what these questions do is really help you understand what's going on inside that fund manager's head and how they're approaching these enormous interconnected challenges.
Fantastic. And why is it so important that we're directing this private capital towards decarbonisation of the economy?
So we clearly need to do it from an environmental perspective. We're also pleasingly responding to clients' wishes for portfolios to be aligned to their non-financial values. Now, that's a big shift, as you know, that's taken place in our industry over the last 5 years, where retail investors or ultra-high net worth clients across the piece really are wanting their portfolio to do more than just generate a financial return. And that additional return, we can call it impact, we can call it contribution to tackling global challenges. We do use the word impact very, very carefully and want to, if we do, quantify that impact and make sure that information is available. But having clients coming to us and saying, I want to do more with my money, has been a major driver for us. But also coming back to this point around, we are taking that role as fiduciary duty and our role as a steward of our clients' capital very, very seriously. That doesn't mean we make a decision to allocate clients' capital towards a certain area without their wishing it. But equally, if these are the opportunities, if this is where the growth areas are, the growth markets are, if we can see risks, and those could be reputational risks, physical risk connected to climate change, it could be transition risk around stranded assets, that is something that we should absolutely be considering. And it's more clear than ever that climate risk is a financial risk.
This sort of leads on to the next question. It's good to hear that your clients are really sort of aligned with this, but we have had this perhaps more negative sentiment coming through towards sustainable investing. After a couple of years of record flows, we've seen some concerns around greenwashing, lots of negativity in the US. How are you dealing with that at LGT, and what are your clients saying? What's
going on in the US is obviously quite disappointing. The fact that sustainable investing, ESG, whatever phrase we're going to use, has been turned into this sort of political hot potato and used as it's been weaponized from one side to the other. But I think it's quite easy to get wrapped up in that sort of negative headspace when really, if we look in the summer of last year, the fact that the US passed that watershed legislation and financial commitment to spending in this space.
The Inflation Reduction Act?
Exactly, IRA, yeah. So that's $400 billion to be spent over the next 7 years in energy efficiency, in renewable energy, in green hydrogen. And that really marks a huge turning point for the US. Now that's with a pretty split government, a pretty split Senate, a pretty split House. The fact that that was passed, I don't think we should not take a lot of comfort and enthusiasm around that. Clearly, there were political issues or political drivers. War in Ukraine, the trade war, Cold War between China and the US was also a driver.
Yes.
But there is a lot of money flowing. And if you look at the specific states where this ESG politicization is happening in the most, that's actually where this Inflation Reduction Act is having the most power from a financial perspective. And interestingly, it's mostly in the form of tax credits. So this is incentivizing businesses to spend money, do CapEx in this area, and then they're benefiting from a tax credit perspective. So it's quite an innovative way of looking at it. We can't dismiss the fact that last year, unless you'd been looking at the S&P, for example, unless you'd been invested in traditional energy, it was extremely difficult to generate a positive return in the equity market. We all saw that longer duration fixed income assets got hit harder. And if you look at things like social bonds and green bonds, they tend to have a higher duration profile. So sustainable portfolios naturally got hit a little bit harder in that drawdown. However, if you look over the longer time period, and I say longer, 5 years, not a super long time period really, that performance differential closes, or you're still seeing better performance for sustainable portfolios across the board than traditional. So I think that there's a few things to consider on the negativity. There is issues around greenwashing, and it's really important for clients, for financial advisors to look underneath the bonnet, to question their investment managers, question their fund managers, to understand how they're doing it and how they're integrating these issues. I think the political thing is a bit of a sort of teething issue, and the politicization, unfortunately, is something that needs to be overlooked, but I think it's getting a lot of articles and it's quite a clickbaity conversation. Actually, beneath the surface, there is quite a lot of progress being made.
Okay, well, it's great to hear that. Thank you so much for your time today.
Absolute pleasure.
Thank you.